Professor Namyong Lee's long-form commentary, reading the next wave in Rocket Lab's stock as Elon Musk's Starlink opens the orbital economy. The orbital economy is not a communication story, but a supply chain war. Low Earth orbit satellite networks, LEO, low Earth orbit, the low altitude band a few hundred kilometers above Earth, are not just another internet service, they are a redesign of national infrastructure. Satellite internet is an industry where satellites, payloads, launch vehicles, ground stations, spectrum, insurance, regulation, and security are bound into a single bundle, and only the firms that can take responsibility for that entire bundle to the end will win long-term contracts. In this arena, stock prices are not determined by poetic technology narratives, but by how tightly the system of accountability is engineered. The customer base also has layers: governments and militaries, buyers of national security missions, commercial telecom and Earth observation companies, buyers of growth demand, regulators and standards bodies, designers of licensing and safety, and capital markets, judges that convert risk into price, pull the same system toward different objectives. The way these four groups are interwoven becomes the revenue model, and that revenue model is what lifts or breaks the stock. Therefore, the question of whether Rocket Lab rises or falls is in truth the question of whether Rocket Lab can seal the allocation of responsibility among these four groups all the way to the end. This is no longer an era that ends with a successful launch. It is an era in which the winners are the companies that can bear total mission cost, TMC, including accidents, end-of-life disposal, and regulatory audits. The new rule Starlink has imposed is simple: swallow safety as a cost. Starlink is pursuing a plan to reposition roughly 4,400 satellites in 2026 by lowering them from 550 km to 480 km, a choice intended to reduce debris risk by accelerating atmospheric burnup in the event of failure. Lower altitudes shorten satellite life and increase operational burden, but they also represent a declaration that collision and debris risks in congested orbits will be priced in upfront. The scale is also numerically overwhelming. In 2025, SpaceX is widely reported to have conducted more than 160 launches, with more than 120 of them expanding Starlink, a factory-like expansion of a constellation through high-frequency launch cadence. Starlink's user base is also reported to have surged into the multi-million range, meaning the service has moved from experiment to infrastructure. At this scale, the market standard is reshaped into mass production and high-frequency operations. Operators that cannot meet the standard collapse under insurance premiums and regulatory costs. A company that can absorb safety as a cost sets the standard. The company that sets the standard rewrites procurement and insurance rules, and the company that holds the rules pressures competitors through cost. Rocket Lab is not merely a launch company, it is an orbital hardware platform. If you view Rocket Lab only as a small launch provider, you miss the essence of its valuation. What the company truly targets is the path to becoming a firm that delivers missions end-to-end by bundling launch, manufacturing, and payloads into one integrated offering. From the customer's perspective, contracting separately for launch, spacecraft, and payload disperses schedules and accountability, raising total cost. The party that holds the entire responsibility in one hand gains pricing power. The floor under cash flow is typically built by government and defense demand. The narrative that Rocket Lab drew market attention by securing a major satellite delivery contract in U.S. defense space procurement, signaling entry into the national security supply chain, is not a one-off headline. It is the acquisition of a credential. Defense contracts require quality, security, schedule discipline, and accountability at the same time. A company that passes these demands becomes more likely to be reused in the next procurement cycle. This is where a structure emerges in which one award pulls in the next award. Electron and Neutron are the two engines that split the present from the future. Electron Rocket Lab's small orbital launch vehicle that provides dedicated small-sat launches and functions as a cash flow engine in the few hundred kilogram class LEO insertion segment, exists to launch often and prove often. In the small-sat market, dedicated launch reduces customer schedule risk, so cadence and success rate become the core of competitiveness. If this pillar fails, no future vision converts into stock value. Neutron, Rocket Lab's next-generation medium-lift reusable launch vehicle, and a growth switch intended to enter the medium market and change the unit economic structure, is the event that changes the company's weight class. The medium-lift reusable market is a long campaign in which facilities, testing, manufacturing yield, launch site licensing, insurance, and regulatory compliance are entangled at once. If repeatable success is demonstrated, the market will reprice Rocket Lab not as a niche launcher, but as an alternative medium-class provider. If delays and uncertainty grow, the premium is discounted instantly. To understand Neutron, you must also hold on to the component vocabulary. Payload, the effective mass delivered to orbit, is the number that divides market segments. Fairing, the shroud that protects payloads from aerodynamic and thermal environments, is a symbol of cost and reliability. Captive fairing, a reusable architecture that treats the fairing not as a consumable, but as an asset, sits at the center of profitability design. The stock trend is a staircase-style re-rating, and volatility grows structurally. Over the past year, Rocket Lab has produced a clear uptrend. The range between lows and highs widened significantly, and volatility expanded near the highs, a pattern in which higher highs and higher lows persist while daily and weekly swings grow. This is not because it is a space company, but because the company currently sits on the border between an earnings stock and a catalyst stock. A staircase structure appears in which valuation jumps whenever catalysts arrive, when expectations that government and defense awards will form a cash flow floor, expectations that Neutron success will change the company's weight class, and the reality that Electron proves execution through repeatable success accumulate together, the stock climbs one step. When a catalyst gap opens, the premium is cut first. When markets rotate into risk-off mode, high beta names get slammed downward through overreaction. Therefore, this name must be read with the premise that it is not quietly compounding, but building steps through events. Compliance and standards are barriers to entry, and launch is a licensed industry. Launch is technology, but it is also licensing. Licensing timelines shake corporate roadmaps, factory ramp plans, and launch windows simultaneously. Satellite communications also live or die by spectrum and market access. Spectrum filings, international coordination, interference management, and ground station certification become part of system competitiveness. Korea is no exception. Launch licensing, liability, and insurance obligations operate as a forced signal to private firms. It does not end with success. Design cost to include accidents. If the public consumes space as pure romance, losses ultimately return through taxes and insurance premiums. To grow the industry, the state must raise regulatory predictability while refusing to hide the cost of accidents. Space debris is not morality, it is cost, and standards become price. As LEO congestion grows, debris risk is booked not as political rhetoric but as cost. On-orbit fragmentation risk, end-of-life disposal, and burn-up in failure become cost items. Operators that cannot bear these costs are pushed out by regulation and insurance. International standards and operating norms are becoming increasingly specific. Debris mitigation requirements bundle demands for launch phase remnants, on-orbit fragmentation prevention, and end-of-life disposal into a single set of obligations. If you cannot prove it with design and operations documentation, you can be excluded from procurement even if you have technology. Starlink's altitude-lowering decision is a representative case of accepting this cost reality in advance. The one-year outlook is determined by whether Neutron evidence earns the premium. The outlook around January 2027 collapses into one question: whether Neutron, a medium-lift reusable launcher, is proven not by words but by evidence. If the first flight succeeds and 2 to 3 follow-on successes appear within a short interval, the market begins to price an option as expected cash flow. The conservative scenario is a $30–50 range. Premium compression if Neutron is repeatedly delayed, testing, licensing, insurance issues intensify, and markets tilt risk off. The base scenario is a $55–90 range. Even if schedules are imperfect, integration tests and launch site readiness track forward, and government contract visibility holds. The optimistic scenario is a $90–140 range, justifiable only when repeatable success and additional awards are confirmed together. The 5-year outlook hinges on whether platformization succeeds. The outlook around January 2031 is driven not by short-term headlines but by business structure. If Neutron enters stable commercial operations and integrated contracts that combine launch with spacecraft payload supply expand, Rocket Lab can be reclassified from a launch stock to an orbital infrastructure stock. The comparison set changes from that point. The conservative scenario is a $20–60 range if Neutron fails to establish commercial footing or scaling is constrained by competition, regulation, and capital costs. The base scenario is an $80–180 range if Neutron ramps steadily and repeat awards across government and commercial customers coincide with narrowing losses. The optimistic scenario is a $200–350 range if Neutron operates reliably at cadence, reusable design drives costs down, and security, telecom, and sensing demand expand together. The biggest risk in this band is not technology itself, but the accumulation of capital market conditions and regulatory insurance costs, and only the firms that withstand these costs earn a platform premium. Ignorance plus greed produces losses, while numbers and institutions protect accounts. The biggest two traps for the public are clear. One is ignorant optimism that turns space will always go up into a religion. The other is incompetent fear that throws everything away at the first shake. Both destroy accounts. The checklist for Rocket Lab must remain simple. Whether evidence accumulates behind Neutron's schedule, medium reusable, whether government and defense awards roll into follow-on quantities, whether Electron dedicated small launch, continues to support cash flow through repeat success, and whether compliance, standards, and insurance are managed as costs. When these four advance together, the next step in the stock is built. If the public treats the stock market as a casino, the costs are ultimately shared by society. Companies must engineer responsibility, investors must understand responsibility, and the state must grow the industry by improving regulatory predictability without hiding accident costs. The orbital economy is not romance, it is competition in responsibility, and only the firms that prove that responsibility in numbers are rewarded through stock prices. Professor Namyong Lee's long-form commentary. Thank you for watching.